So when you get to retirement and you've got a defined contribution pension, you've got a decision to make when it comes to taking an income. Do you use annuities or do you use drawdown, for example, to try and provide the best and maximum income throughout that retirement? Now, just as a reminder, an annuity is where you take your pot of money and you'll give it to an insurance company, for example, and in return, they will give you a promise of a guaranteed income for the rest of your life. Now, there can be different versions of annuities. You can add on, for example, guarantee periods. You can have joint annuities, so it will pay out an income to a partner if you die. Is you give your money over to the insurance company and in return, you receive this guaranteed income. The other option is drawdown, where you can use your pension pot flexibly and you can draw income from it when you need to, but you can also keep most of it invested in the market so it can grow. Of course, there is investment risk with that. Now, the reason why this is particularly relevant now is because annuity sales have been surging. So in the last year, the number of annuity sales have actually risen 24%. That's a 10-year high. And now the increase is largely down to annuity rates, and that's because they've been rising. So annuities are still one of the best ways to get the maximum income from a retirement pot. Now, just to give you a sense of how much annuity rates have risen, if you go back to 2022, a 65-year-old with 100 grand would have received about £4,540 a year, assuming they took a level annuity. So the income wasn't increasing year on year in line with inflation or anything like that. And there was no guarantee period. So basically, when they died, the income stopped. Now, a 65-year-old today would actually get an annuity rate of 7.54%, which means that if they had £100,000, they would get £7,540 today. That's a massive jump. And the reason that has happened is partly because we've seen gilt yields rise. So annuities are clearly becoming much more attractive to people today. So what do people do? Do they take an annuity for that income, or is it drawdown? Because you've got that flexibility that you get with drawdown, but there's also that investment risk. Well, it's not an either or decision. And what I want to talk through is some analysis that's been carried out by Standard Life. And what they did is they looked at 3 different scenarios. So somebody who's age 65, and they compared the outcome if they had £150,000 pot of money in their pension, and they did one of 3 things. The first one was the traditional level annuity. So this involved the person using their entire pension pot at age 65 to purchase a level annuity. Now, this provides a fixed income for life, meaning you know exactly what you're going to get. And in the case of somebody who had a £150,000 pot of money, the level annuity that Standard Life worked out that they would get roughly, based on typical annuity rates, was £10,151 a year. Now, that comes to a total income when you get to age 90 of having received £253,775. So a large sum, assuming that you actually made it to age 90. Now, this approach obviously eliminates all investment risk and your payments are guaranteed, but there are significant downsides. So firstly, inflation's the biggest one, because inflation significantly reduces the buying power of any income you get each year. And secondly, you miss out on the potential improvement in annuity rates that may occur as you get older, because the older you are, the better the annuity rate you get, because obviously when the insurance company factors in your life expectancy, they'll pay you a bit more money because you're not actually expected to live as long. And the most important thing of all is that once you've bought your annuity, so a level annuity, you lose a great deal of flexibility with this particular option. So the next scenario they looked at was if somebody bought an RPI-linked annuity. So it was like the level annuity scenario, but your income was increasing at 3.5% each year. So protecting that purchasing power of your money. Now, if you buy an inflation-linked annuity, the initial amount you get is lower than if you buy a level annuity. So in the same example they gave, they had a £150,000 pension pot, would get a lower income initially at age 65 of £6,565, but it increases each year by that 3.5% assumption, as I mentioned. So that means in year 2, you get £7,797, and so on and so on. It means that the total income that person would receive by age 90, based on the scenario that they've created and the calculations, that total amount was £255,706. Now, the downside, of course, is the initial annuity rate is lower than the level rate. And the other downside, of course, is that you've paid your pension money across for that annuity and you've lost access to that money. So the third scenario is the phased annuitization with drawdown. So instead of buying a single annuity at the start at age 65, instead they looked at the scenario where you bought a level annuity in phases and you keep the rest of the money that you haven't used to buy an annuity in drawdown. So in Standard Life's example, what they did is they assumed that at age 65, the person bought a level annuity using £90,000 of that £150,000 pot. Then every 5 years thereafter, they used another £20,000 to buy another new level annuity. And the remainder of all the money was kept in drawdown, and they assumed a 5% annual investment return and a yearly income derived from that drawdown of 3%. Now, if you look at the analysis, it indicates that this strategy could potentially provide a total income of £259,115 by age 90, which is higher than both of the single annuity options that I've mentioned earlier. But furthermore, the annual income in this scenario starts at £8,155 at age 65 and gradually rises to £12,065 by the time you reach age 80. Now, this combined approach gives flexibility, and you've still got money in drawdown, which you could theoretically pass on to the next of kin. I won't get into the IHT treatment of that because things are changing with regard to drawdown. But more importantly, it gives you the ability to benefit from the rise in annuity rates as you get older. So each subsequent purchase of an annuity, you're getting a better annuity rate, assuming that obviously annuity rates don't suddenly crash because gilt yields do. So that shows you, by using a combination of annuitization over a period of time with drawdown, you have the potential of securing a greater income. And the other thing is there is the flexibility that if your scenario changes and you need to access that drawdown pot for whatever reason, then you can do it. So the point is that there are solutions out there that can match our retirement. Because if you think about it, a lot of people now, retirement isn't a sudden stopping point. For people, it's a gradual transition. They may change careers, they might change hours, might start working reduced hours. But that flexibility does require a bit of a more nuanced approach to managing pensions. So annuities are an important part of maximising retirement income, and there are plenty of options with them. So, for example, you've got fixed term annuities that can help bridge an income gap between retirement and maybe when your state pension begins. But you've also got enhanced annuities that I've talked about in other videos, where you can get a better annuity rate because maybe you've got a health issue or maybe you're just a smoker. And there are drawbacks, of course, to annuities that I've talked about. But ultimately, what I want people to take away, that a combination approach to retirement is something that you should consider. And it's not an either or decision. But more importantly, make sure you speak to a financial advisor, because a good financial advisor can go through all of these options and build a plan for you. Now, if you don't know a financial advisor that you trust, then there is an article on the Money to the Masses website, which there is a link to in the notes of this video, which will show you how you can find one using the various resources out there.